meant to be an educational webinar focused on better understanding, our investment strategy of currently the preferred return equity fund that's investing in this Class B housing, multifamily space. But then we also really predominantly lend in this Class B space as well. So this is the residential asset class that the vast majority of what we do at DLP revolves around. And we think it's a great place to be today, and it's going to be an even greater place to be over the next few years, which I'm going to hopefully show to you here today, why we came to that conclusion and why we think it's really makes phenomenal sense today, even more so than when we came to this conclusion a few years ago. So with that said, we do have, I'm looking at the list of people on here today. I see some names that I don't know, so welcome. That means we have some people who are not currently invested with us. So I'm going to do just a couple minute overview to give a little bit of overview on us and our background, so that we have a little credibility in what I'm going to talk about here today, and then we'll get right into Class B housing. So our principles here, and this is really important to why we choose Class B housing, is because we believe in these following investment principles. No losses to investors ever, period. No, that's a bold statement. Consistency in our returns. And then our third principle is generating as high returns as we can, with those first two principles or rules being non-negotiable. And in 12 plus years of managing money, investing in housing, we've had no losses to investors, and we've been very, very, very consistent returns. And we're determined to continue that as we continue to grow through all market cycles, including the one coming here in the next, certainly within the next few years. A little bit about myself: 12 years in real estate. This is year 13. I've closed over 8,500 real estate transactions, close to $1.5 billion in real estate transactions. I've acquired over 1,000 properties. Ranked as one of the top real estate professionals in the U.S. by the Wall Street Journal, and the CEO and founder of our family of companies. And we currently own with our investors over 8,000 apartments and homes, predominantly Class B. And then I'm the father of those two little boys on the left, and my wife and our family had a Jacksonville game a couple weeks ago, Jaguars game. We live in St. Augustine, Florida, the majority of the year, and have a home in the Lehigh Valley as well. Partners here at DLP Capital Partners: Bob Peterson, our CFO; Barry DeGroot, General Counsel. Very significant members of our company, and specifically here to this strategy as well. So as we get started here, first let me define what Class B is, and then get into why we like it so much. So Class B apartments are not luxury in quality. They are typically apartment communities that were built prior to the mid 2000, early 2000, very often built in the 80s and 90s. They typically don't have all the amenities that you would expect in brand new communities. Typically don't have elevators, typically don't have as nice of common amenities. That picture there is actually, I just saw my marketing team put in, is actually really, that's a Class C apartment community, C+. That's a community we own in Titusville, Florida. So we will buy C+ type communities such as that. We really focused on today on the B space, but it's all very, very similar in that we're focused on workforce housing, affordable housing. So here are some examples. These are the actual communities we own today. I know those pictures, depending on your size of your computer screen, might not be all that clear, but they should give you at least a little bit of feel to the look and feel of the types of communities we own. That top left, that community was built in the early 2000s, 426 units in Gulfport, Mississippi. The next one, 419 units, views at Long Creek, late 80s. Foxgate there was late 80s, and some of the property was rebuilt in early 2000s. Our most recent acquisition and the first property purchased in the preferred return equity fund is that property there that says Arbor Trace Apartments, which was just rebranded this past week to Prosper Azalea City. That was built in, I think, 87 to 89, 300 units. I'm going to show you a little bit about that community here in a few minutes. So those are some of the examples of some of the communities we own today. So why we invest in Class B housing? So I'm going to ask this question. If you happened to be at our investor dinner last week, I asked you guys these same questions as well. How much do you think rent has increased in the past 10 years on average? And if you'd like, type in your guesses here in the chat box, that'd be awesome. If not, that's fine. But how much do you think rent, meaning apartment rent, housing rents, have gone up over the past 10 years? So from 2008 to 2018. And what percentage of new housing built in the US do you think was Class B? So two questions there. How much have rents grown in the past decade? And what percentage of housing built today do you think is Class B? So I'll give everybody a couple seconds if you want to type your answers in that chat box. Awesome. All right, so got some good guesses there. Nobody quite on. The past 10 years, rents have gone up 54% across the U.S. That's the average across the U.S. 54% increase in the average rent, meaning if an apartment cost $700, 10 years ago, today it costs $1,050. And 10 years sounds like a long time, but think about it. That's since 2008, which was the quote unquote peak of the real estate market, right? When the world was falling apart. Since then, despite going through a major recession, rents have gone up 54%. Yet in the affordable space, which has actually gone up slightly more than 54%, the space we're in, this Class B space, 0% of housing being built today is Class B. Everything being built is Class A. Everything being built is luxury. As one of the reasons why this space is experiencing such great rent growth is there's no new supply. So to contrast the increase in rents, the average U.S. income over the past 10 years has grown by just 4% for the bottom 70% of wage earners. So the type of tenant, the people who are typically renting, which are the 70% bottom wage earners, so the bottom 2/3 of the average earners in America, have had their incomes go up just 4% over that same period of time. So again, 10 years, rents have gone up 54%, yet incomes for basically for renters have only gone up 4%. That's a problem, right? Especially considering everything being built is luxury, meaning it's $1,400 a month, $1,500 a month, $1,800 a month, $2,000 a month rents, yet the incomes aren't growing there. This is creating a compounding effect on the need for affordable housing, which is why Class B has such tremendous demand. And that's why when we believe when the next market correction comes, the next recession comes, which it will come. I'm not here to predict today if that's going to be next year or the year after that or the year after that, but it will be here in the foreseeable future. We believe that rents and occupancy are going to remain strong, which means our cash flow, our returns to you as investors is going to remain strong. We think occupancy is going to remain very high and rents will be stable and very likely even continue to grow just as they did in 2008, 2009, 2010, 2011, even as we go through a recessionary environment. That's why we love the space. Now, on the other hand, this Class A space, where rents are $1,700, $1,800 a month, we go into a recessionary environment, may really have some troubles with occupancy as rents as even more people move to the space of affordable apartments. So we're another reason, or maybe to define that a bit further, this Class B space and the kind of returns we get. We're buying properties and are able to achieve an 8 cap rate at our costs. What that means is if we bought a property for all cash, we would get about an 8% return just from rental income, not factoring in appreciation, not factoring in any tax benefits, just simply looking at not factoring in the value we create through our management and through the improvements, just looking at cash flow, we'd be generating about an 8% return. That's a great return in any market, as a great cap rate in any market, and that's what we're buying at today, despite how much competition there is, despite how much money is chasing this space. We cannot get those returns. We cannot achieve those yields in the Class A space. We'd love to. In certain markets where there's not, where we don't think there's going to be an oversupply of product, we'd love to buy a Class A product, but we can't get those kind of yields. When there are those opportunities, which will likely be when there's a recessionary environment, there'll be some distressed opportunities. We may buy more Class A properties at that time. But we have to be able to get yield, and we have to be in a market with the right supply and demand metrics, which we'll talk more about, which is, again, why we land on Class B housing today, why we think it's such a great place to be as we go into a market recession. The risk in Class A, as I already touched on this a little bit, is many markets have lots of new supply. In the city of Jacksonville, which is down the street from where I am right now, there's thousands, I think it's 6,000 last I heard, new apartments being built right now. Most decent sized markets have tons of new Class A apartments being built. So when there becomes a time when there's too much supply, either because there's been too much product built for the population, for the demand, or when we go into a recessionary environment and people are moving out of Class A into Class B or even Class C, and there's more supply than there is demand, that's going to have rents go down, and there's going to be higher vacancies. That's simple supply and demand. There's more supply, pricing goes down. When there's more demand, pricing goes up. So during a market correction, we think people are going to be looking for lower rents. So either Class A space is going to have to drop their rents to the market for the people who need lower rents, or they're going to have higher vacancies as people move to the Class B space. Often when I get to this point, especially when I'm talking to investors who invest in real estate at all, but certainly invest in housing, often say, well, how do we get these 8 cap rates? And I want to make it clear, you can't go out there today. If anybody in this meeting says, all right, Don, this sounds really good. You sold me here today on why the Class B space is so good. So I'll just go out there and do this myself. What do I need you guys for? I can go out there, and now I understand. I'll go find some 8 cap rate deals, right? It's not that easy. Most Class B properties today are selling in the 5 cap rate pricing, meaning if you bought that property with no leverage, you'd get a 5% return from rental income instead of 8. It's a hard thing to do. It's not something you can just decide today. I want to go buy some properties at an 8 cap rate. We're able to do so because we buy value. So we leverage our relationship with banks, with brokers, with sellers to bring us a lot of deal volume, 400 to 500 deals a month that we're looking at. We leverage our size and our credibility to win out in bidding situations, to get brokers and banks, so forth, to bring us distressed opportunities. We leverage you, meaning our investors, DLP Capital Partners, our access to capital, and our ability to move fast to beat out competition for deals. And we leverage our in-house resource team to be out there pounding the pavement every day, looking for opportunities to find deals. We're looking at 400 to 500 deals a month to buy 1 deal, 2 deals. This is in general what we're focused on, predominantly Class B. We're value add, which I'll explain what that means. Usually we're buying properties between 5 to 40 million. Usually we're buying not 200 to 0, it's supposed to say 200 to 400 unit communities. Typically we're in the Southeast, Florida, Georgia, North Carolina, South Carolina, Alabama, Mississippi, or one of our next deals in Louisiana, Baton Rouge. And then we do still buy when we can find opportunities in Pennsylvania, New Jersey. Again, our target cap rate has been saying 8, but really our target cap rate is 8.5. And then in turn being able to generate cash on cash returns of 12, meaning once we use leverage, we're generating double-digit returns from rental income, from cash flow. We also achieve 8 cap rates by driving value through both the physical improvements we make to the properties and through strong property management. Here's some of the leaders in our property management company. They were all in my office here in St. Augustine yesterday in an all-day, we call clarity session. Right now, they're all working on budgeting for 2019. All right now, we have a really great leadership team of regional managers, executives, asset managers, people who oversee the capital improvements. You see there, Hank and Carlos. And then we also have additional in-house resources on the construction side. Larry Greenberg oversees our construction company, project leaders, etc. Another way that we A, drive value and B, reduce risk is through debt. So we're able to attract and place the best debt out there, non-recourse, typically agency debt Typically, our loans are 30-year loans, but we have our interest rate locked in for 7 to 12 years. So our interest rate's locked in for our entire investment period. So we're not exposed to either our loan coming due and having to pay it off, so we have 30 years, or our interest rates going up because our rates can't go up during that 7 to 12 year period. Again, as I mentioned, we're looking at 400 to 500 deals a month. You see this kind of funnel. 100 of the deals we're looking at every month, 40 to 50 deals a month that we're taking a full, deep evaluation. 20 to 30 deals every month. We're out physically going to the properties, going to the competing properties, going down to the codes office, going down to the police station, diving deep physically at the property in the market. 15 to 20 properties that we're putting offers in on every month to get 2 or 3 offers accepted and buy 1 or 2 properties. It takes a lot of effort to get through all the due diligence to get comfortable with the deal at the price we're paying, and know it's a solid investment. As I said, we add value often through physical improvements. Pretty much every deal we buy, we're doing significant or some level of significant improvements, often exterior work of replacing roofs and addressing parking lots and landscaping and drainage issues. And then we're almost always coming in and renovating and upgrading apartments, adding amenities to a community, again, improving the management, and in turn driving up rents, increasing the occupancy, decreasing maintenance costs, increasing our tenant retention, all things that drive up the terminal value of the property, the end value, as well as increase our cash flow. So here's an example of a property, and some of you are in Pennsylvania. This property is in Belvedere Street in Nazareth. This was a 9, I'll call them apartments, but they were the second and third floor were actually like rooms almost, because the bathrooms were on the other side of the hall and they had shared bathrooms. 9 apartments, and then a dry cleaner and a tattoo parlor on the first floor. And the units were in horrible, horrible shape. We came in and redid the whole exterior, as you can see. So look at the exterior there. It was an almost completed picture compared to there. All new windows, doors, facade, roof. And then every apartment looks identical to those pictures there. We turned it into 16 residential apartments. Took the rents from $400 a month to $900 a month. It's been a great property. We did that about 2 years ago. This is a typical Southeast property, or somewhat typical. We own 9 properties like this today. These are all very similar. These are single-story apartment communities. Very often we come in, you can kind of see in this top right picture, like wallpaper, wall coverings, some mildew issue there, that black, rough kitchens, rough, issues, a bunch of different issues often, many of the units. Then we come in and we clean up the exterior, as you see there in that picture on the left. That's the same community. And then we put in hard surface floors and new cabinets, resurface them at least, new counters, stainless steel or black appliances, fresh color, fresh paint and lighting. I've already said it, hard surface floors, strip out the wallpaper and redo the walls. And now we often take these rents in these communities like this. We'll come into a 1-bedroom apartment rented for $450, $500 and increase it to $650, $700. Attract better tenants, lower maintenance costs, increase the end value, better cash flow, etc. Here's another example. This is a property in Brunswick, Georgia. Had 40 apartments that were completely down, unrentable for 10 years when we bought this property. These are some pictures of a couple of those units, what they look like. And we came in there and turned them into this. Again, all hard surface floors, other than we had some carpet in some of the bedrooms for certain reasons. All new doors, new vanities, new kitchens, fresh light colored paints, etc. And took rents here from $600 to about $1,000 a month through these improvements. So that's why we invest in Class B. That's why we invest in properties that we add value. We can increase our cash-on-cash returns, increase our overall returns by being able and willing to do the hard work, like some of those pictures I just described. And so we focus on Class B, but we also typically focus on going into smaller markets, secondary markets, some call tertiary markets, which are usually smaller than a secondary market even. And we go into these markets because there's a greater opportunity due to less competition, i.e. there's less investors in those markets competing with us, but then there's also less product being built, meaning so there's less competition for tenants or for residents. In turn, we get higher yields, also by being in lots of small markets versus being densely focused on one or two bigger markets. We have a lot more diversification in our portfolio, from everything from from economic issues, employers coming out of a market, to natural disasters and so forth. We go into strong local economies in the Southeast. It's phenomenal. There's so many great smaller markets with phenomenal job growth, phenomenal population growth, thriving military bases, universities with really great, diverse economies that we can really capitalize on, and really a lot of pretty much what all this sums up to is we can get we're going into markets with great supply and demand, supply and demand dynamics. And we invest in the South, so we go into secondary and tertiary markets, but then mainly in the South because there's the best population growth in the South. People want to be in warmer climates. I don't think that's going to change. There's great job growth, tons of manufacturing jobs, so forth, are coming into the South. And again, that means great supply, great demand. And then in these markets, or in these small markets, there's no new supply. So lots of demand, no new supply. Again, great supply and demand dynamics. This gives you here kind of on a map, all these little houses, if you can see them, are the different communities we own. So you can see we're very heavily focused throughout the Southeast. Here's an example of a property we own called Brandon Court. This was one of the first, I think this was the first property or second property we bought in the Equity Fund 2, our last Equity Fund. These are 3 communities we bought in Warner Robins, Georgia. Here's one that we bought called The Corners last year in Spartansburg, South Carolina. This is a 176 unit Class B community. Pretty nice modern amenities, nice units, big nice pool, big clubhouse. This is one of our largest communities, 419 units built in the late 80s. Really nice setting. You can see some of the pictures of the typical interior units there. This is the community actually I showed those really rough pictures on in Brunswick, Georgia before. These are some examples of some of our finished unit in the top right there. And then the bottom right is the office. That's the office / clubhouse at that community. We're actually just rebranding that community right now to Prosper. What's the term I'm looking for? What's the island there called? Golden Isles. Prosper Golden Isles. Rebrand's going on right now to attract a higher quality tenant. This is one of our higher end communities. It's called Prosper Orange Beach. These are built in the early 2000s. This is our largest community, 426 units, built in the early 2000s. I think 2003 was this community. We just rebranded all these communities a few months ago, all branded as Prosper. So it's Prosper Orange Beach. That's our lifestyle brand. So Dream, Live, Prosper. We've been branding all of our lifestyle branded communities, these Class B communities, as Prosper communities. So again, another comment back to why we invest in the South. Again, there's phenomenal population growth. Both people, young and old, want to live in warmer climates. A study that was done a few months ago by, I think it was close to 100,000 people over the age of 55, over 50% said that they would choose to rent. So it's not just the younger generation. The younger generation certainly is choosing to rent, and certainly are choosing to rent longer, starting their families and becoming homeowners much later, and some not at all. But also the baby boomer age, the 55 up, are also choosing to rent, are also choosing to get out of their homes into communities and being renters, not having the responsibilities and being tied to a place and having the maintenance of a home. So both young and old are moving in the direction of renting and moving in the direction of moving south. Again, lack of supply. Real estate, just like most investments, is about supply and demand. Right now in the U.S., there's 300,000 apartments units being built. that are over 5 units, meaning so it's not including single family homes or 2 units or 3 units or 4 unit properties. So 5 unit or larger communities. There's 300,000 units under construction right now. The average cost of building one of these units or apartments is, depending on the market, on average, it's over $150,000. The average Class B apartment today is worth 60 to 80 grand. We're typically paying around 40 to 45 grand. So you can see the math there. It costs 150 grand to build an apartment, yet the Class B apartments are only worth 60 to 80 grand. So obviously you can't afford to build a Class B apartment because the cost is too high, which is why everything that's being built is Class A and why they have to be luxury. They have to charge $1,500, $1,800 a month rents because when you're charging $700, $800, $900 like the Class B space, the math doesn't work. You can't afford to build it. And that's why everything being built is Class A. And again, there's a continued increased demand. Right now, we have the highest percentage of Americans renting today that we've had since 1965. 37% of Americans today are renters. The highest, again, it's been since 1965. Within the next 3 years, we will have the highest percentage of Americans who are renters ever. And many expect that to continue into the 40s percentage. I've heard numbers as high as 45% in 5 years of Americans, meaning another 8% of Americans will go from being homeowners to renters, which is somewhere around 15 to 20 million. Well, I mean, actually, it's as far as number of people, it's actually about 25 million people would go from being living in a home they own to being renters. That's pretty significant. And in addition to more people going from being homeowners to being renters, just in general, populations are growing. And especially, as I've said already, populations are growing in the South. So demand for rental is going up due to people becoming renters and because population is growing and migrating south. So this supply and demand results of the supply and demand metrics that I've been talking about has led to, so far this year, the first half of this year, rents have gone up 3.4% across America on average. And this just continues to create this affordable housing epidemic where rents keep rising, incomes are not, and all the new supply is not affordable. Which it's not good for the overall average American, but it's good for us being operators and investors in the Class B space. So here's an example of one of our most recent properties. This property was the first acquisition in our newest investment fund, the Preferred Return Equity Fund. It's a 300-unit apartment community in Valdosta, Georgia, which is central South Georgia. It's about 2 hours from Jacksonville. Had about 90% occupancy. It had 16 units in need of renovation, 12 that were destroyed through a fire. Rents were about 15 to 20% less than where they should be if it was being managed well. We bought it. It's called Arbor Trace Apartments. We just rebranded it Prosper Azalea City. This town, Valdosta, Georgia, is called Azalea City. That's the nickname. So this community does have, it's a nice looking community. A lot of mature trees. Built in the late 80s. Has 2 pools. You see one of the pools there is a fitness center. Off of one of the pools there is that bottom right, the little right-hand side building is the fitness center. The main building is the clubhouse and office. It's got a playground. So there's some nice amenities. It's got a park a public park next door to it. We paid $38,000 an apartment, $11 million, a little over $11.392 million. Our cap rate here by 2019, or by our second year of ownership, we're expecting to be over 8.6%. Year one, our cash-on-cash return, not even factoring in the refinance that we're going to be doing. The first year will be conservatively a 5% cash-on-cash return, but year 2 will be over 12%, year 3, 14%, year 4, 15%, year 5, estimate 16.5%. And the annual internal rate of return on the investment, assuming we sold it in year 5, will be 23.7%. That's a pretty average deal for us. It's a great deal. We'd buy this deal 10 times over. It's a great property, but that's an average deal. What we're focused on today. There's some pictures of the inside of the units. So about 16 units are completely in need of full renovation, but then a lot of the units look like this. We'll be coming LI's units on the turns and doing some upgrades on the kitchens, the appliances, as the carpet needs to be replaced, replacing with hard surface flooring, etc. Average rent today is $609. We expect to increase that to about $725. Take the occupancy from about 90% up to mid 90s%, and really drive the returns here in this community. So that's a good amount of information here. Hopefully that made sense to you. And if you haven't ever heard any of this before, hopefully it made some sense to you. You've been hearing this a while. Hopefully this brings a little more clarity to what we do and how it works. So I'm going to go ahead and take us off of mute. Try to anyway. So in a couple seconds, I'm going to talk. I'm going to take everybody off mute. So before I do so, make sure if you're on your phone, put yourself on mute on your phone, or if you're logged in through the computer and you're listening on your audio, click your mute button if you don't want to talk, so we don't hear whatever noise you have going on in the background. And then you can also type in questions via the chat box as well. So all right, I'm gonna go ahead and take everybody off mute now.
Hey, Don.
Yes, go ahead.
Thanks for hosting this webinar. I really appreciate it. How can I invest in this? And then what are the investment minimums if I was interested in doing this?
Yeah, great question. So I did not even really push the fund details here was to be an educational overview. But the short answer is, you heard me say a couple times, we have the Preferred Return Equity Fund. That's our fund that invests directly into this strategy. We opened that fund just a few months ago. Just bought that first property I just showed, under contract on a few communities right now. So in that fund, the minimum investment you'll see marketed is 500 grand. If you're an existing investor, you can really invest any amount of money once you're an existing investor. If you're interested in that fund and 500 grand, it doesn't work for you, we can go down to 250. How that fund works, you'll see it on our website. We'll send out the information with a recap of this video as well. But the short is, just like we talked about buying properties in 8 cap rate, being able to generate, strong returns from the rental income, that's really our focus. So our goal is to distribute to our investors 8 to 9% returns each year, paid out quarterly. So in other words, if you invested 500 grand, our goal is to distribute to you 10 grand every quarter off of rental income. And then at the end of the fund, our expectation is that we'll pay back 150 to 200% of your original investment in a 5 to 8 year period of time, giving you an overall return of over 12% annual rate of return on your investment. So if interested in learning more, you can take a look on the website, or you can simply, I'll send a follow-up after this. You can reach out to myself. If you've already talked to Larry or Bob or Mike, you can talk to them directly and they can fill you into more information. And I should mention, if you say, look, this strategy makes sense to me, but I don't want to be in a fund that's a longer term fund. As an example, our lending strategies, both the income and growth fund and the lending fund, lend money to real estate investors investing in the strategy. So if the foundation of having your money in a place backed by these types of assets makes sense to you, you can also participate in this strategy of investing in Class B housing as essentially as a lender, and get very liquid, have your money very liquid, and also get very strong double-digit current returns. So great question. Question here is, how many apartments do we plan on acquiring in the Preferred Return Equity Fund? So that's a good question. Our last fund, which we opened in March of 2017, was called the Equity Fund 2. We had that fund open a year. In a year, we purchased 3,697 apartments, I believe, for close to $250 million worth of apartments. So I would say, there's a good chance we'll be somewhere similar there. Probably at least a couple thousand apartments in this fund, likely across 8 to 15 different apartment communities across multiple markets and states. So that Prosper Azalea City, the one I just went over here, was the first property we bought, and under contract on a couple right now. That'll be going here, that we can share that information out on if interested, if anybody wants that information. depends how much capital gets invested in the fund, how many of our assets go into this. But we purchased over 5,000 apartments here in the past 15 months or so, and expect we'll do about the same over the next 12 to 15 months. Great question. So next question was about where we're buying. If we looked at Tennessee or any other markets like that. So let me show that again here. So here's where we own communities today. Tomorrow morning, bright and early, I think I head out at 3:30 in the morning. I head to South Bend, Indiana, where we're under contract to buy 750 apartments right near Notre Dame. That would be our first acquisition in Indiana. We've looked at a number of deals in Tennessee. We don't own anything in Tennessee right now. We're under contract right now on 4 communities in Baton Rouge, Louisiana. So that'll be our furthest west we've gone so far. So we're open to. We looked at deals in Texas. We haven't gotten to Texas yet, but we've gotten close a few times. So we're really looking for markets where A, we can get our yield, B, where there's the right supply and demand metrics. So if we can find those markets in the Midwest or out to Texas, we're willing to go there. It's a great question. So appreciate that question, Joe. So one of the questions was how do we handle going into a new market where we don't have resources or people or boots on the ground, as we call it. So when we go into a new market, every community we buy, an average community like that 300 unit community I just showed, Prosper Azalea City, we have a property manager, an assistant property manager, a leasing specialist, and 3 or 4 maintenance techs. So we employ 6 or 7 people at that community. So we'll go out there. Sometimes we do hire the staff who works there for the seller. Most of the time we don't. And we go out there and we hire and recruit locally, which we found to be, almost easy is not the right word, but we've had no problem being able to attract the best talent in the market. We're an exciting, growing company. We treat our people great. We have a phenomenal culture. So when we come into a market and they do a little research and see what we do, see how we come in and improve communities, make them great places to live, great places to attract quality tenants, that we come in there and actually invest money to improve the community. It's very easy for us to attract, again, easy is probably not the right word, but we've had no problem attracting great talent. So we put a local talented team who knows the market in place. They typically have vendor relationships and so forth as well, which is helpful. And then we have regional property managers who oversee a specific region and are on site at each community on a regular basis. And then we have multiple project leaders and site supervisors throughout the field overseeing the assets and the improvement projects as well. So most of our communities, believe it or not, we have a corporate team member, a regional manager or a project leader or an executive out at most communities. I'd say on average 1 person every week. So they're getting lots of touches by us. And then we have some really great GC vendors and subs, roofers, and so forth who will travel all throughout these markets for us. It's a lot easier than it is, our kind of our original path of buying single family homes and smaller assets. It's easier with these types of larger communities to find quality contractors and vendors, and because we're staffing each community with people, it makes it a bit easier in having people on site at each asset we purchase. So it's actually been really great going into new markets and being able to attract and expand our talent base. Great question. Any other questions? Again, everybody, I have a couple people who are on mute who I think I found who was talking, so I put a couple people on mute, but otherwise I don't have you on mute, so you're able to go ahead and talk verbally, or as many of you have been doing, type them in the chat box. And you can type a message into the entire audience or just to me directly. Go ahead.
Yeah, I've got one more question regarding the taxes on this particular fund that you're talking about. I have an old 401k, but that doesn't sound like this would be maybe a good fit for that. Could you talk maybe about the tax, how you're taxed on this money in this particular fund?
Yeah, great question. So I didn't cover much of the investment side of this other than I gave that little overview on the returns. The other really attractive part of investing in this strategy and doing so as an investor within a fund like the Preferred Return Equity Fund is that all of that cash flow. So I gave the example of 500 grand investment. I was distributing out to you 10 grand every quarter. So that's 40 grand a year. That 40 grand we would distribute to you in a year. All of the return or the majority of that return is going to be deferred from tax through depreciation. So it provides a tax shelter, tax deferral that we're able to depreciate these assets and create a taxable deduction that will defer much of your actual income that we generated and distributed to you. So this is a great strategy. If you have money that's not retirement money, as your example, 401k money or IRA money, to be able to get some tax shelters and defer those gains from Uncle Sam. And then what's great is, so we distribute out to you 40 grand and very little of it is taxable this year. And we do the same thing next year, we do the same thing next year, and so forth. And then say 5 years from now, we sell the properties and we return you 150 to 200% of your original investment. Now you are going to pay taxes, but you're going to pay long-term capital gains versus being taxed at ordinary income. So you had the time value of money, you deferred giving Uncle Sam 30, 40% of your money each year and got to keep earning money on your money. And then when you do finally pay taxes, it's going to be at long-term capital gains, which I don't know where they'll be. None of us know where they'll be in 5 years or whenever the fund winds down. But historically, they've been much less than ordinary income. Historically, they've been roughly half of what you pay for ordinary income. So it's a very tax advantageous place to be. So we certainly do get people who invest retirement money in this strategy. They say, yeah, this strategy still makes great sense. I still like it. I still think it makes good long-term sense, and it's still the highest overall return yield of any DLP strategy. So that's where I want to go. But most people, we find, if they have qualified money or retirement money, 401k, IRA money, they tend to go into our lending fund or our income and growth fund, where now you get to shelter what would normally be ordinary income from tax, and then invest their cash or non-qualified money into this strategy. And if you're an investor with us today and you say, well, I already have, I have, I have, my cash money in the lending fund right now, as an example, but I do have some qualified money I want to invest, we can help you swap your money from one fund to the other to get more tax advantageous as well. A great question. Anybody else? Any other questions? All right, awesome. Well, I appreciate everybody sticking with us through this this overview. Great questions, great overview. We did record this. We'll shoot this out if you wanted to relook at anything. Plus, we'll send you some information on the Preferred Return Equity Fund as well if you have interest in investing in this strategy. And I hope everybody has an awesome rest of your Wednesday. Thanks, everybody.